Are you someone looking to up your game this year by investing more in the hopes of building wealth sooner? Well, keep listening as we review some common investing mistakes and how you can avoid them. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Alicia Taylor.
And I'm Dr. Brittany Halford.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time.
All right, Alicia. It is still snowing and then raining and icing here in Boston. And I'm like, okay, you know what? I'm done with this. I am done with winter. But I know that you all had a day where it was like 78 degrees. My nieces were in shorts. So you're probably just living a life in Atlanta. Tell us what is going on in your world.
Yeah, the weather here is very interesting. One day it's like 20, 30 degrees. The next day it's like 70. And you're like, is it spring? The weather's been interesting, but I love warm weather. So I've been enjoying it. I actually just came back from Oklahoma City. I actually went to a funeral, so that wasn't so great. But I was in Oklahoma City for a funeral, and the weather there was also fantastic. I think when I was there last Saturday, it was like 80 degrees, which is insane. After the funeral and all the crying and all the things, I was like, let's go outside. Let's go for a walk. Let's go out to eat. Let's enjoy and soak up the sun. And so I've actually been enjoying the warmer weather a little bit. I've been running outside or trying to at least. And so trying to make the most out of life and look at it from a glass half full kind of perspective. And one of those glass half full perspectives is the warmer weather for me.
I love it. I love when you can turn something that is bad into a moment of joy and of appreciation. So I'm sorry for your loss. Let me first say that. It never gets easy. Like, I don't know, unless it's like a person who's 98 and, she lived a great life, then you just celebrating and partying essentially at the funeral. But funerals, loss, and death, it just never feels good. So my apologies there. But I'm glad that you were able to at least enjoy the weather and the experience and kind of have a more positive outlook on everything.
Yeah. So on that happy note, one of the things that does make me happy is anytime that I log into my Fidelity account, girl, and I see the balance going up. Okay. It's so funny because I don't know. I think this is the same for everybody, but when things are going up, it's kind of like in green. And then when things are going down, it's kind of like in red. Like there's a big number at the top that tells you how much you have in investments. But then you can see within each portfolio, like, all right, is the majority of the portfolio kind of going down today? Is the majority of the portfolio going up today? And when I log in and I see the green, I'm like, okay, all right, we are doing something. So I'm actually very encouraged by the portfolio size. And I think within the last couple of years, it's been going up for the most part. I'm assuming it's the same for you. Like these last few years have actually been pretty good from an investment standpoint. Yes, there's some day-to-day volatility, right? Some day-to-day, maybe slight downs or slight increases. But overall, things are moving in the right direction for me personally. And that always makes me feel good. Is that the same for you, Brittany, when it comes to your investing portfolio?
Of course, more dollar signs. You look at the contributions, that line is like flatter, like simple interest. But then when you see the other graph, you like, yes, money, compound, exponential growth. I'm all there. So I do appreciate that as well. And Alicia, I just gave a talk to some people at my church, and I always show these graphs, just starting where you are. I think sometimes when we are concerned about getting everything right with investing, we lose the opportunity. We focus on what we don't have instead of focusing on, okay, even if I have $1 and this single dollar is able to earn additional dollars, then that's worth investing. I think with this conversation, we're going to talk about some of the common mistakes, but we just want to give you all permission to start because you don't have to do everything right. We're talking about seeing the dollar signs increase, and we want that for you as well. So, Alicia, open it up. What is one of the first common mistakes that you see people making with their investments?
Well, I think you hit the nail on the head right there. I think it's waiting too long to start. Sometimes we have this assumption that I can't start investing right now because I don't have a lot of money, or I think I need more money, or I think that the money that I currently have is insufficient to really make a difference, when none of those things are true, right? You can start where you are, just as you said, right? You don't necessarily need more income. You don't have to wait until you're completely debt free. You don't have to wait until there's quote unquote better timing. But I think one of the most common investing mistakes is waiting too long to start. And you have to realize that good can sometimes be the enemy of perfect, or perfect can be the enemy of good, however that saying goes. But sometimes you just have to start where you are. Life may not be perfect. You may not think that it's going to make a big difference. But I was reading this book one time that said, every dollar that you put towards investing is you being able to purchase another ticket towards your financial independence, another ticket that can garner you eventually the ability to retire at an early age, another ticket towards your journey of being able to cut down to part-time, another ticket towards your journey of being able to outsource some things in your life, or be able to afford your kids college education, or whatever other financial goals that you may have. And so I think oftentimes we think we can't start where we are. We think we should delay. We think sometime in the future is a better time than right now. And none of those things are true. So one of the most common investing mistakes that I see is simply waiting too long to start.
Definitely. When they talk about the various currencies that we have, the one thing that we cannot make more of is time. And so how can we leverage time? And that's exactly what you're talking about, is leveraging time. And by investing, by allowing our money to grow for us, we are leveraging time. Because if we think about the listeners of this podcast and ourselves, yes, we're entrepreneurs, so we are our own boss, but this podcast don't write itself, people. It's not AI. This is Leisha and Brittany on the mic.
Definitely us.
We are exchanging our time to build another currency, to have some money, build an audience. Those are all things that we are exchanging our time for. But what if you don't have to exchange your time? What if your dollar could earn you money? What if your dollar could help you to build all these other aspects of your life? And that is what investing is about. It's about leverage, and leveraging time, the most precious resource that we have. Why not do it? How much more would you give for an extra day in your week? Man, that sounds good to me, right? Extra day in my week. And what if instead of going to work that extra day, I could still make the same amount of money without doing anything? And that is what investing is all about.
Yeah. Have you seen those graphs, Brittany, in a lot of the finance books where they'll be like, person A starts investing at 25 years old and they invest $10,000 a year. And person B starts investing at 35 years old. And it's like person A starts at 25 years old, but they only invest for 10 years, versus person B starts at 35 and invests from age 35 to 65. And how when they both get age 65, the person that invested sooner for a shorter amount of time actually ends up with almost twice as much money as the person who delayed and invested more. And so it's like one of those graphs that really articulates, at least to me, or showcases to me, the power of compound interest and the power of time, and how oftentimes it's not even how much you invest, is how soon you start investing, because you want to give that money time to compound. And so for a lot of us who may not be in our 20s anymore, the best time to start investing is right now, where you can't do anything about time that you may have lost, but you can avoid making another mistake by delaying even more. And so kind of starting where you are is what our goal, our lesson is for this first point.
Yeah, I love that. Okay, so let's go to this next one. You know how some things could trigger you in the wrong way and then things could trigger you in the right way. And right now, I just got a lot of laughter in my spirit. I'm sorry, people. But it's trying to time the market. And the reason why I laugh is because I am a simple investor. I put that money in, I kind of set it up, I forget it. I want to keep it boring. I'm not trying to work too hard. You all know that I work hard in other areas. In my investing strategy, when I'm investing in the market, I kind of make it easy for myself. But I've had a colleague where they know I like money, so they're like, "Oh, Brittany, did you see this stock?" I'm like, "What you talk about? What you talk about, Willis?" Or however the saying goes. I don't know. I don't time the market. I'm not looking for these ups and downs. Now, there are times when I see, oh, things are falling. Let me just, if I have time, check in to see if I could do a tax loss harvest situation. But that is the only time that I am trying to time anything in the market. So I don't try to buy when everybody's saying buy, and I don't sell when people are like, oh my gosh, things are crazy, unless I have a little bit of time. I'm like, oh, if I sell, could I make some room on the taxes here? That's it. And I see too many people really being motivated by what the headlines are and changing their path with their investing only to end up farther behind.
Yeah, I see that too. It's so funny. I ran into one of my colleagues, I think it was like late last year or something. And she was like, Dr. Taylor, you taking your money out? I heard things are about to go down. She was hearing that the stock market was going to go down. And she was like, oh, I'm going to take my money out of the stock market so that I can sort of avoid that loss, so to speak. And I think she's not the only one. There are times where maybe it's predicted to be some sort of economic downturn or something. And so then you have people on social media, people on news headlines, people in your day-to-day life that are telling you, oh, get your money out of the market, take your money out of those stocks before they go down. And one of the things that's important to know is that one of the quote unquote costs of investing is dealing with volatility. What is volatility? That is the simple fact that things are going to go up sometimes and things are going to go down sometimes. But overall, things should improve. When you look at it from a year-to-year basis, from a decade-to-decade basis, things tend to go up most of the time. Even though you have these day-to-day changes, you kind of have to stay invested. And so my point here is sharing that although some people might be taking their money out of the market, trying to time the market, trying to avoid some of these market downturns, what you learn to do over time is to just keep it in and stay steady. I am not going to be swayed by rumors of an economic downturn. And even if things do go south, they tend to rebound. And so you have to kind of reframe how you think about things. Instead of saying, oh, my stocks went down, is saying, oh, now I can buy them at a discount because I know that overall things are going to improve. And so instead of trying to buy things when it quote unquote feels safe or jumping out of the market when it feels unsafe, learning that you got to deal with some volatility and that you have to stay steady and continue to invest throughout it all.
Amen. Amen. Okay, Leisha, take us to the third mistake that you see people doing.
Yes, the third mistake that I see people making is letting their emotions drive their investing decisions. What do I mean by that? I mean, various emotions can kind of hold us back from reaching our financial goals. Some of those emotions are fear, right? I'm afraid to invest because I'm afraid I might lose my money. Some of those emotions are greed, right? I'm trying to get rich so quickly. I'm trying to get as much as I can that now I'm taking more risks than I probably should. And I'm sort of putting myself at a disadvantage overall. Some of it is regret. Some of it is analysis paralysis. You kind of know what you should do, but you don't feel 100% certain. So you're kind of paralyzed and you don't do anything and you keep sitting on the sidelines. And so I think for a lot of people, sometimes the emotions that we have, whether it's fear, whether it's greed, whether it's regret, whether it's analysis paralysis, they can prevent us from sort of reaching our financial goals and investing as diligently and as consistently as we should. One of these things that I also see sometimes is overconfidence. We feel like, oh, we know it all. I know what this crypto stock is. I know what Bitcoin is. I feel confident in it. And so we maybe put more than we should or a higher percentage of our money in one particular stock or one particular thing than we should. And we end up taking too large of a risk. And so I think for some people, it's letting their emotions drive their decisions is another common investing mistake that I see.
Yes, yes, yes. This is resonating with me in so many ways because right around the time of the pandemic, we saw many people who were older. This didn't impact us so much, but those who were older nearing retirement see dramatic losses. I can say that I have a family member who pulled their money out. And when you do that, when you act emotionally and pull all of your money out, like your colleague said, then you lock in those losses. So yeah, you could try to get out before the dip, but most people don't. And so if you just ride the wave, then you will see that there's a rebound. And unfortunately for this person now, they've locked into a very, very conservative return because they're like, oh, I can't lose anything else, so I need the guarantee. Give me the guarantee. And unfortunately, sometimes guarantees are lower returns. Now, I can understand. They're like, okay, well, I basically negate the risk. So I accept this lower return and that feels safer for me. Basically, we're not trying to judge anyone who's made emotional mistakes or allowed emotions to drive your investing strategy because we understand that a lot of finance is behavioral finance. But what we encourage you to do is to address the emotional side so that you don't allow the emotions to dictate your financial decisions. Because when you do, you may be losing in the long term. You may be locking in losses that you didn't imagine or even understand what the consequences of those actions are. So sorry to get like all therapeutic on y'all, but I have seen and now I'm helping family members to kind of deal with this. And this is why it's really important that we try to have some type of separation, try to create a financial and investing strategy that helps to mitigate those fears. So if I get afraid and I want to take my money out, what do you do? Do you add in time delay? Do you add in, okay, well, I'm going to sell this one thing first, but not all of it? Kind of create a strategy around that because we don't want your emotions to drive your decisions.
Yeah. Well, in addition to those things, I think one thing that helps me prevent my emotions from driving decisions is by putting things on auto pay or automatic transfer, right? I do not go in and say, oh, I want to invest this amount this month. It is automatically taken out. And my life is so busy. Even if I would have thought, oh, that would have been nice to maybe keep in my account. Oh, it's already gone. Now I'm too lazy to move back and all the things. And so it's the default is the correct thing that I want to do. And so taking some of the guesswork out of it, taking some of the decision making out of it and putting things on automatic. Another thing is some people employ a financial advisor for this specific purpose. Like if you know you're the kind of person where you see a big dip and you're panicking, that's fine. At least you know that about yourself. And I think this is where a financial advisor might be helpful for you because they could help you steady things. They could help you maybe talk you off the ledge and prevent you from taking your money out during the dips, prevent you from making other investing mistakes. And so if you know you're that kind of person, that's fine. This is maybe where a financial advisor comes in that can kind of help you talk you through some of these decisions so that you don't make decisions in haste or based off of emotions.
Okay, Leisha, I love that. I'm thinking like, because financial advisors, and I have a friend who's a financial advisor. I love him. If you're listening to this episode, I'm not going to call you out, but if you are, I'm not trying to step on the necks or talk poorly about financial advisors. But I just want to encourage you that if you're pursuing a financial advisor for that sole purpose, then allow that question to drive your interview and ask for some examples because I think sometimes they are also trying to time the market and that they make more emotional decisions. And studies have shown that with the assets under management that you're going to pay them, that 1% of assets under management, you actually end up losing a little bit more when you have a financial advisor investing for you because they often choose, and I can say this because we have a financial advisor for one of our accounts, often choose very high expense ratio investments. I don't remember what episode that was where I talked about how I had to really question the financial advisor and push them to act differently. All that to say that there are some good financial advisors if they're going to manage your money for you, but make sure you interview them and make sure that single question, if that's what's driving your desire to have a financial advisor, that they answer that appropriately.
I agree wholeheartedly. I don't like to say cheap because I feel like it has a negative connotation. I'm going to say
It
frugal,
does. Frugal.
frugal, cost conscious.
Discretion. Yes.
And so that's one of the reasons why I don't have a financial advisor. But I do think that for people who maybe don't feel as confident managing things on their own, maybe a financial advisor could be helpful. And again, if they have a little bit of difficulty controlling their emotions through it. But as you mentioned, it is very important to interview that person and make sure that they're a good fit and make sure that there aren't other downsides to working with the financial advisor, including costs. So thank you for that really keen reminder. I think another common investing mistake that I see a lot is when people confuse activity with strategy. They think, oh, I got to do stuff in order to get a good return. And one of the things I love about passive index fund investing is that it does not require any additional work from me. My life is so busy. I got so many things going on. The last thing that I want to do is add reading the Wall Street Journal each day to my to-do list. I just do not have the time. And I think some people, they think, oh, if I'm investing, then I got to constantly listen to all these finance podcasts and I got to check into my checking account and I got to rebalance all of my investment portfolios and I have to log into this account or that account each day and see what it's doing, or I have to buy or have to sell something. I need to start day trading. I need to start doing all of these things. And one of the things to keep in mind is that good investing is often boring, right? Good investing sometimes is just setting it on autopilot, making sure that you're periodically buying these index mutual funds that are low cost and setting it and forgetting it. And then oftentimes, I think the studies show this, Brittany, I think you brought this up before. Studies show that the people who actually log into their accounts the most and have more activity actually tend to have lower returns. Right. And so oftentimes, this is why a lot of the research will show that women make better investors because we're less likely to start buying and selling stuff. We're like, look, I don't know what's happening. I'm just stay right where I am. That steadiness is actually helpful. And so don't confuse doing more things with actually being more successful. Don't confuse activity with strategy.
Leisha, you're so right about women investors. And that was something that I shared actually at this talk that I gave. And it shows that it's about, I think, zero point 0.4 to 1.1% that women get more additional return on their investment compared to men. And so
that's hundreds of thousands of dollars. People looking at 0.4 and they're like, what is that? No. It's a big amount. I mean, think about it.
It's a big amount.
If you're a physician, even if you're not a physician, right? If you are an educated professional making around 6 figures per year, if you are contributing the maximum to your work retirement accounts each year for 20 or 30 years, you're going to end up with eventually $500,000, $1 million, maybe $2 million in your retirement accounts alone. 1% of $1 million is still a lot of money. That is like a big deal. To lose that amount each year is a big deal. I mean, you're missing out on hundreds of thousands of dollars by simply doing more buying and selling instead of just staying steady. Sorry to interrupt you, but I had to emphasize that point, girl.
No, you're right. And I appreciate the emphasis because basically what we're trying to share is that these are not just mistakes that we have seen through our life experience, but these are actually documented in literature and have been studied. So, we like evidence-based medicine, evidence-based finance. This works. Tried and true. Keep it simple. Make it consistent, automatic. Don't think about it. When your colleagues say, hey, are you selling? You like, no, I'm not, because I don't time the market, because that's what Dr. Brittany and Dr. Leisha told me not to do.
Hey, I get it. So don't confuse activity with strategy, as we've harped on already, okay? Another investing mistake that I see a lot, Brittany, is not understanding what you own. You ask people, are you investing? They're like, yeah. It's like, oh, I have a financial advisor or something. And then you say, well, what are you investing in? They're like, I don't know. He takes care of that or she takes care of that. It's like, I think that you should be empowered to understand what your money is being invested in. I mean, you got hundreds of thousands, ideally, maybe even $1 million invested. Don't you think you should know what that money is invested in? I find that sometimes people sort of follow the crowd, even though they don't fully understand what it is, whether it's some complicated whole life insurance policy. You ask them why they have it, and they're like, well, I need life insurance. And they said something about I could borrow from it. And you're like, do you know how that works? And they're like, Or some complicated annuity that they don't fully understand. Or maybe it's some individual stock they heard was going to go through the roof. Maybe it's some new company that they haven't fully vetted, some sort of cryptocurrency, whether it's Ethereum or Selenium or Bitcoin or whatever, that maybe they don't understand. Some NFT. Remember when that was all the craze? Now you don't hear as much about it. Some sort of alternative investment or complication or thing. I find that for me, it's best to keep it simple. I want to make sure at the very least I understand what is happening with my money, how much I'm paying in fees, and what it is invested in. I'm not saying that you need to be able to memorize the top 10 investments that you have, but I do think it's important to know, generally speaking, what your money is invested in.
Couldn't agree more. I think this is important. One, just to be aware, because no one is going to care more about your money than you do. And then to let that financial advisor know, if you're using them, that you care, that you are paying attention. For me, when the person now know that I'm paying attention, they change their behaviors. And so they're like, okay, well, Brittany, we know she does not like these high expense ratios. So we're going to choose a different alternative. Yes, we have to choose mutual funds, but we're going to actually go with this one instead because that's more in alignment with the goals of this individual. That is really important. Also, because you might want to do something different. Maybe they're investing in a way that doesn't align with your values. And that's kind of where I am now. And we'll have to do a whole episode about ethical social governance investing, ESG investing. But that's kind of where my head is. It's like, do I want to actually be investing in companies that are doing this to people or taking this action? No, I don't, because that's not what I would do. And so it's important that you know, okay, what is the composition of what you're investing in? Also ensuring that it aligns with your value. And that is not too expensive, because overall, you want to use your money in a way that feels good. At least for me, that's like my goal. I want to use my money in a way that feels good to me. And I can't know for sure that it feels good until I know what I'm invested in. All right. I've talked about fees a lot. So I think this last one here, Leisha, is overconcentration, or another way to say that is like not diversified enough. and you have too much of your portfolio in one single stock or one asset class in one industry. And unfortunately, what we find when that happens, when you put all of your eggs in one basket, is that you take on a lot more risk in doing that. Now, that risk could be risk of loss if there's a downturn or that single investment doesn't perform well, or that risk could also be a loss of growth because, again, maybe that thing is too conservative for you. And so you're not willing to expose yourself enough to actually reap the full return on your investment. And I find that this also is a big risk when you're thinking about taxes because how you're investing, if you're investing in mutual funds or if you're investing in certain types of bonds or certain types of assets, they have different taxation. And so you really want to understand how you can diversify your investments very simply. We're not saying to pick like 100 stocks, individual stocks, or 100 different asset classes. Not 100 asset classes really exist. But to go crazy, that's what I was saying. We want you to be diversified, but we don't want you to do it to the extreme. Maybe choose 3 to 5 asset classes that you want to invest in and then figure out how you want to invest in them.
Yeah, I agree. I see this over concentration mistake a lot in various different ways. One is like employer stock. This isn't as applicable to physicians, but I see it in folks who work like in the tech industry, where a part of their pay is like these reserve stock options, or for folks who work for large corporations. For example, my brother used to work for Coca-Cola, and so part of his compensation package was Coca-Cola stock. I myself, when I was doing some work for Doximity, I got Doximity stock. And so sometimes when you're working for these corporations, part of your compensation is stock in the company. And I think for some people, they can be over concentrated in that. If your job is with one corporation and then the vast majority of your investment portfolio is in one corporation because you have all of this stock, then if you lose your job or if the company goes down, then you're hurting both ways. And so one of the things to try to avoid is over concentration in one particular stock. I also see this in folks who have too much concentration in one particular asset class, whether that is an asset class in the tech industry or an asset class in cryptocurrency or an asset class in real estate. And I'm not saying that there's anything wrong individually with those asset classes, but I do think that you need to proceed with caution if all of your investment is in that one asset class. What happens if something happens with that asset class? It goes down in value, things happen that you could not have predicted. Then you might lose a vast majority of your investment portfolio and your net worth might take a huge hit. And so being sure to kind of diversify in different asset classes. And lastly, being sure that you're not over concentrated in one industry's stock. I've heard a lot of financial gurus, they will say, oh, you don't need to invest in the S&P 500. You don't need to invest in the US Total Stock Market Index Fund. You could just invest in the 7 main tech stocks. These 7 main stocks are accounting for the vast majority of growth. You have these companies like Nvidia, Apple, and Google, and they're like, hey, just invest in those companies and you'll be fine. And I think when you center a lot of your investment money in one industry, what happens if that industry tanks? And so I think a way to avoid that is to make sure that you are diversified. And for me, that means putting my money in index mutual funds that are already diversified. And so that includes S&P 500, Total Stock Market Index Fund, Total International Index Fund, making sure that you diversify across different industries, across different asset classes, and across different stocks is extremely important.
All right. Well, we've talked a lot about mistakes in investing. There's going to be a whole part 2 of this, but I think it's time to transition to some fun money. Leisha, how are you spending your money for fun?
Ooh, good thing. I am going to get my hair done. This week, I am going to get my hair washed and then I'm going to get some braids. I love having my hair in braids. It is very low maintenance for me. And so being able to kind of wake up and go is something I very much look forward to. I also am very much looking forward to the ability to work out and have my hair sweat without having my hair look a mess. And braids are great for that. So, girl, I am spending some fun money getting my hair done, more specifically, getting some braids.
That's so funny. On the walk home today, after dropping off the kids this morning, I thought about my hair and I was like, okay, I need to take these braids out. Okay, when can I take the braids out? And then what do I want to do next? So I usually go between braids, twist, and then getting my hair straight. And I don't like to put too much heat on my hair. But you're right. When you have your hair straight, then you go for a run or it's a rainy day, it requires a little bit more planning. So I wholeheartedly hear you on that. What I have been spending my money on is fused beads. I don't know if you've heard about this before. So,
Mm-mm.
how old are your nieces and nephews?
My niece is 3. Nephews are soon to be 2, soon to be 1,
Okay.
and soon to be 4,
Okay,
I
so
think.
maybe the 4-year-old could do this, but I think it's probably a little too mature of a toy for the others. But essentially, it is where I have like one here. You put all these little beads on a mold and then you iron it. And so they kind of fuse together.
I did that as a kid. I remember that. Little
Yes,
daycare activity.
yes. So yesterday, I should have brought the other one. Yesterday, I made this little turtle with the kids, and it takes a while. So I was like, oh, I don't know if we're going to be doing this every day because mommy doesn't have the time or the patience. And if you knock one of them off, then sometimes all of them fly off, which is a little bit of a headache after you've spent all that time. But it's been a fun activity for our kids, and they've been creative, not using the mode and kind of creating their own designs as well. So I like to give my kids activities that doesn't require the screen. And so this is definitely one that takes some time. So if there are any moms listening and you have a child that's 4 or above, I would say buy this. So for a rainy day, they work on their fused bead activity instead of watching the screen.
So is it called fused beads? Like, can you spell it? I
Yeah,
want to make sure I'm hearing you right.
FUSED beads.
Fused beads. Okay. All right. I like it. I like it. I like it. Thank you for the tip. I'm going to keep it in the Rolodex with my niece and my nephew.
Yeah.
All right. Hopefully you all found this episode helpful. We will be back to you next week with part 2.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, you know. So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.